Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence. Last week's theme of traders reining in expectations of Federal Reserve's interest rate cuts seems to be something that may have its spillover into this week's moves. A soft start risks extending last week's global sell-off as investors price the prospect of Donald Trump's tariffs and tax cuts potentially reigniting inflation in an already robust US economy. A report of Friday's October retail sales that included large upside revisions also aided bets that the Fed may pause its easing cycle in 2025, with the odds of a rate cut next month now seen reducing. Good morning, JK. Any particular expectations from this week? Any trends you would be closely watching?
Good morning, Swaraj. Yes, we are back after a long weekend. I think what we are observing is unlikely to see in this week is also a pause in the Trump trades that have gone quite a distance in a very short period of time. That includes stocks, currencies, and the yields as well. So we have seen some reversal in the US stock market on Friday. Then we have also seen the yields stalling near 4.50 for the 10-year and also at 4.40 for the 2-year. Then currencies have really not broken clearly above 107, which means that we are still in the broad range that we have seen in the last 1 year. So what is the investors' minds is, yes, we know all the negative things are going to happen for the other regions if the Trump's policies are finally coming through. But then what we are looking at is whether how well these countries are prepared. For instance, China has been already doing a lot of stimulus measures to support the domestic consumption and perhaps not to depend too much on their export. So even if they get their exports get affected by Trump's policies, they may still be not so bad. And also we have seen that the impact of any tariff and all that is seen with quite a lag. So whether the market has jumped the gun and bought into dollars too much is something that we are observing. Also in Europe, they are almost nearing a crisis situation where the economy is really stalling, and then political situation is also not good. Germany will have its re-election in February. All these things are not good. But then historically, we have seen that Europe also responds whenever there is a crisis, and they respond quite strongly. So this is what the market is looking at, whether these countries have now made their plans to how to counter the new situation arising out of Mr. Trump's re-election as president. That's what the market also wants to see. So I think I'm not saying dollar is reversing to the downside. I'm saying that dollar is possibly passing also in the range between 105.50 and 107. It might hold, and we are also moving into the year end. And we know that the Trump administration will not take charge until January 25th. So the big decision implementation will also take some time. So these are the reasons why I feel that Trump trades will also take a pause and maybe some correction wherever there is some sort of a overdone situation, which is what we saw in the stocks. And even in the Bitcoin, which has slipped from a high of 93,000 to around 87,000. Gold, in fact, fell more than 10%. And gold is one market which had not really bothered, or rather been influenced by higher yields in the US, which is quite contrary to what we have seen traditionally. So gold falling 10% may actually lure the central banks and also the investors, if it is closer to 2,500 or below that, I think gold is also likely to. We've already seen some bounce in the gold, but maybe some range movement before it can, take some decisive move also. Yes, even Powell's statement on Thursday, where he said they may have to go in a measured way on the further rate cuts, not to go in a hurry, is also nothing new for the market. So that's why we haven't seen too much of a. On the data side, of course, retail sales headline was good. But if you go into the details, it was the core retail sales actually was negative, and that actually goes into calculation of GDP. So that is not a very encouraging sign. Jobless claims were lower, which means that the job market is better off. Industrial production on the other side was still on the negative. So we're still getting the hard numbers from US are still quite on the mixed side. In Europe, we had employment improving, but then the industrial production was down. Japan GDP was better than expected, so giving rise to some speculation that the governor of Bank of Japan may indicate a rate hike in December. But today, when he spoke, he has been non-committal. But it's still possible that with yen having moved towards 155 plus, we may still see a rate move from Japan. So a lot of things that the market is looking for after having discounted so many possibilities of the new administration in the US. That's where we are taking a pass, according to me. As far as the rupee is concerned, I think the moves are more, as we have seen already in the last several months. Rupees moves are governed by the domestic factors. Recent developments have not been so great. Inflation moving above 6% in October. Trade deficit for October coming at 27 billion, which is 7 billion higher than the previous month, and then exports not doing so great, imports rising very fast. And then this is also happening in the context of large capital outflows. Normal India trade deficit has been there always, but then it has been funded by large capital flows. But this year we are seeing outflows so far, and whether we will see a reversal of those flows is something that we have to wait and see. There are indications that the domestic consumption is also weakening. So these and exports not doing well means possible that Indian rupee independently weakens, with the central bank allowing it to fall. The other news not so happy was that the reserves again falling towards 670 billion last week. Sixth week of continuous fall in the reserves. Of course, valuation effect is also there, but then overall, how much the reserves will be spent in the coming days if the outflows continue, and how much the authorities want to support the export sector and keep the rupee on the weaker side is something that we'll wait and see. So rupee's moves will be guided by the domestic factors, not so much by the external factors. On the data side this week, not much, except towards the end of the week we have the fresh preliminary indications on the manufacturing and the services PMIs from all the regions. That is what the market will be looking forward to. Thank you.
Thank you, JK. And just quickly summarizing, a pause in Trump trade is possible as markets seem to have gone very far with their pricing. There have been some profit-taking moves in stocks. Yields have been stalling, and dollar index isn't making further headway. Gold falling 10% from its highs, that may attract some buyers. On the data front, retail sales headline number was good, but the core number, which goes into the GDP calculation, was not so great. Jobless claims was lower, so mixed picture. So overall, a mixed picture from the US economy. When it comes to the rupee, domestic factors are continuing to drive the rupee. Higher inflation, higher trade deficit, and the constant FII outflows keeping the rupee weaker. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.